makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Signs of a cooling U.S. labor market buoy Fed rate cut bets, while Treasury yields climbing after their largest two-day drop this year. The Indian Prime Minister Narendra Modi gears up for coalition talks after his party loses its parliamentary majority, while stocks rebound after yesterday's sell-off. And here in the UK, Rishi Sunak and Keir Starmer face off in the first TV debate of the general election, with the Conservative and Labour leaders trading barbs over their rivals' tax plans. So there's quite a lot going on in today's markets. This is what the picture of European stocks look like. Now, the focus is firmly on data. We also have the ECB tomorrow. A couple of positioning ahead of not tomorrow, but maybe what they do at the next couple of meetings. Now, the ECB's inflation challenge, I guess, looks more and more like the Fed's, which is why we're seeing a repricing in some of the European bonds. European stocks, you can see on the screen, actually advancing. Again, because we've had signs of a cooling U.S. labor market, it does seem that it's changed what investors expect the Fed to do. In Asia, Indian stocks outperformed after an alliance partner of Prime Minister Modi's party affirmed support to form a coalition. Of course, government. Now, a couple of other things we're watching out for. Yesterday was a big day in UK politics ahead of the election, July 4th. You can see Sterling won 27.77, and then S&P futures gaining 0.1%. Again, traders are looking ahead to that expected reduction in interest rates from the ECB. Let's see what happens afterwards, because the policy path beyond this week's cut is probably unclear. So we're just telling you Treasury yields climbing further, or climbed as further signs of the U.S. labor market is cooling, and that's changing what we're expecting the Fed to do. Well, joining us now is Julian Salisbury, a Co-Chief Investment Officer of Sixth Street. Julian, as always, thank you so much for joining us. And it's an exciting week, actually. There's quite a lot going on. And again, it's all about the Fed and actually the ECB, the danger that central banks around the world will have the same problems that the Fed, which is maybe crying victory too soon.
Yeah, look, these, I think as all the central bankers have said, they're going to be tracking data. I think it's pretty clear we're going to see the first cut from the ECB later this week. Our expectation remains that, notwithstanding that, things are going to remain higher for longer, and that's going to put, pressure on financing for corporates across the region.
So what does that mean for private markets? I know one of the big things that you're focusing on is the fact that actually because of the liquidity, available liquidity, some of the valuations, it's pushing more people to private markets.
Look, I'm very optimistic about the investment opportunity set for private markets in Europe. And there's really three things. One, just the size of these markets. There are many places around the world that are becoming harder to invest, more geopolitical risk. And notwithstanding certain election uncertainty and rate uncertainty you may see in Europe on a relative basis, this is a large investable market. Second thing, there's definitely a need for capital here. Growth capital for stimulating the software businesses and other growth companies that you're seeing across the region, healthcare, a huge need for infrastructure investment. That's not just traditional investment in infrastructure, but other things. Some of the announcements you've seen this morning, where corporates are looking for capital to help them stimulate nearshoring, reshoring, changing of supply chain. And finally, frankly, just from a supply-demand dynamic, there's always competition in markets, but on a relative basis, we see less capital here competing for deals on the private markets. And the public markets, the capital markets are, frankly, not as vibrant, and valuations aren't as rich. So you see many companies looking to the private markets as a viable alternative versus public.
There's so many companies actually trying to get into private market. Yep. And the counterpoint is that actually it is a lot less liquid than public markets. And valuations sometimes are a little bit to be questioned. So when you look at private markets, where do you see the biggest value? Is it infrastructure? Is it real estate? Again, these are not assets that fall out of the sky.
First of all, I think there's always this erroneous, view that liquidity and risk are correlated. There are plenty of illiquid things that are very safe, and there are plenty of very liquid things that are highly volatile and dangerous. So I think some of the safer, secure investments are some of the most illiquid. I mean, that's what we've seen over time, just great risk-adjusted returns in the private markets. in terms of valuations, look, I think the public markets are a great tool. They're a great discipline. It's a daily scorecard. It's a daily referendum on the business. And for some companies, it's a great form of capital.
Where do you see value in private market at the moment?
I think where private markets are better are looking through the long term. So if you have business, one of the things we're seeing right now is, for example, corporates who have an investment that they want to make, but it's going to have a drag on earnings. It's going to have a negative impact on their debt ratios. So they're looking to do that through off-balance sheet structures in order, recognizing that they're trying to thread the needle of earnings targets that a short-term driven public market investor is looking for, with more patient long-term capital. So you can look at businesses that are typically experiencing a J curve, or they may be like profitability may be many years away. And the private market investor can get deeper, they can get closer to the business, really understand it, and that's where they're able to extract value. So
again, what kind of assets are you looking for? So you're managing around 75 billion, I think, across growth equity, real estate, infrastructure, asset investing. Where do you see the biggest value right now?
I think here, I'd say three broad areas that we're spending time on in Europe. One is growth. Software's been a huge growth investments, growth companies. So software's been a huge investment theme for us from the beginning of the firm's history, really. But today, that remains a very vibrant and meaningful part of our business. Historically, it was the majority of our business, and while we're diversifying and doing other things, software and growth companies remains a very strong theme for us, both across lending and equity, up and down the capital structure. Really, one of the things I love about our business is we show up and we're not a hammer looking for a nail. We don't have a one-size-fits-all solution. It's, do you need senior lending? Do you need a convertible loan? Do you need pref equity? Do you need common equity? So growth, broadly defined. Second, on the, the infrastructure side, I think, I don't need to go through the numbers, but the needs for investment spend across digital transformation, decarbonisation, deglobalisation
is just across massive. The globe, or are you seeing better values
across the globe? I was in Asia 2 weeks ago, looking at investment around this exact theme. We're seeing it in the US. That's really a global phenomenon.
Space, I would say.
Look, these are big markets, and look, there are on any given day there are tens of thousands of people that can buy an individual stock or bond. On most of these private situations, there are on any given one situation, there's less than a handful of people that are really there at the end of the day that can provide the solution that the company's looking for. And then, the third area, so we talked about growth, we talked about infrastructure. I'd say the third area is just like recapitalization. So there's rates are, not all, you saw quick adjustment in asset valuations when rates started hiking back in, 2021 in public markets. You saw the growth equity reset very quickly. You saw other asset classes reset. I'd say there is definitely a longer bleed adjustment in other asset classes.
And more debt. Is it fair to say there's more debt in private market?
Yeah, absolutely.
And that hasn't played out yet. Does that mean there's opportunities, or there's a bubble risk?
So I think there are, what we're seeing is companies that have debt maturities that they need to deal with. They can bring in more junior capital, pref equity to delever the balance sheet, allow them to turn out the rest. So live to fight another day. You've seen near-term extreme versions of this in the US. You had a lot of real estate where values reset dramatically because of the rate hike. You had relatively short-term debt capital structures. And in some cases like office, you also had fundamental underperformance in the underlying business. So they're needing to go through like extreme fits. I would say here, in Europe, it's less extreme. I think there's less short-term financing. It's not on the real estate side, it's not a vibrant environment, but it's not quite as acute as in the US. But I think you're going to see many companies look to amend and term out their capital structures over the next 2 to 3 years. So I think people often forget when you see these periods of turmoil that it's all going to happen very fast. Post Lehman. It took 4 to 5 years.
But so, are you expecting a kind of Lehman moment at the moment? Lehman moment?
Absolutely no.
That's like alarm bells. You say Lehman.
No. I'm just saying when we had that event, it took many years for all of the companies to restructure. And I would say what you've seen is companies that were maybe purchased and financed in a different rate environment. They're highly levered. I think that the reason I don't think it's a I shouldn't have even used the L words. It will get people excited. The difference today versus then. I remember sitting here in Europe in 2008, huge asset liability mismatches and a tiny private market. And now you have so many larger. It's a very healthy thing for the economy. You have huge pools of private capital that can step in and help restructure when public
Julian,
markets aren't there.
Talk to me a bit about the UK. We have an election July 4th.
Yeah.
Again, there's quite a lot of, I don't know whether there's opportunity in the UK because of some of the mismatches that we've seen in terms of policies, or whether it's just a country that you'd stay away from right now.
Perhaps I'm biased because I'm from the UK, but I continue to believe this is a great place to invest from a property rights, rule of law, entrepreneurialism, business mindset. I do hope that whatever the outcome of the election is, it's always hard when you go back in time. If you had known perfectly what the outcome of an election would have been, I'm not sure it would have been helped you that much as it relates to predicting the path of asset prices in the period shortly or in the subsequent years. But I hope whatever the outcome is, that policies are put in place that will encourage the development and strengthening of the financial services industry in the UK. I think it's one of the great strengths of this country. It has been, and I think we take it for granted sometimes.
So would you play it through software? Would you play it, again, is there anything at the moment that looks attractive for the UK asset, giving some of the possible transformation that we could see?
Look, I was at a dinner last night with a whole group of software CEOs and executives, and they're all very optimistic about their businesses. They're all looking for alternative forms of capital to grow and expand their businesses. I came away from that meeting quite optimistic about the opportunity for us in that space. And look, it's very easy to get pessimistic in the face of uncertain election outcomes, geopolitical risk, rate uncertainty. But again, this is one of the benefits of the private markets. You can kind of not get distracted by the short-term machinations, by the headlines, and you can really focus on the long-term growth potential over a 3, 5, 10-year time horizon.
Julian, thank you so much for joining us. Julian Salisbury there, a co-chief investment officer at 6th Street. Now, coming up, Narendra Modi vows to stay on as India's Prime Minister despite his party losing its parliamentary majority. We'll bring you the details of that next, and this is Bloomberg. Welcome back. Now, this week, we're, of course, keeping a very close eye on what we saw in India. Yesterday, we saw a lot of pressure on some of the Indian stocks, but also some of the bonds. Today, we're seeing a rebound after, of course, Narendra Modi said he will stay in power despite the coalition losing quite a lot. So Modi is now seeking to shore up his coalition to secure this third term. I guess investors think that that means some of the reforms will continue to go through. So you can see the Sensex gaining 2.3% and the Nifty index 2.4% higher. Now, Narendra Modi, as we were saying, is vowing to stay on as Indian Prime Minister, even after his party lost its parliamentary majority in a stunning upset.
Today's victory is the victory of the world's largest democracy. This is the victory of unbreakable allegiance put into the Constitution of India. In our third term, this country will see a new chapter of big decisions. This is Modi's guarantee.
Well, let's get more on this story with Bloomberg senior India editor Menka Joshi. Menka, Modi's victory speech actually seems to have calmed markets.
Yes, it has, Francine. And one big reason is that clip that you played out, that victory speech that Modi gave last evening, in which he left no space for acknowledging any kind of loss or weakness and made it sound like a strength that he returned to power a third time. That seems to have calmed nerves a little bit. Of course, the shock value or shock effect of yesterday's election outcome also wearing off markets as they see both key allies of the BJP, that's Modi's party, reaffirm their loyalty to the coalition. And that suggests that there might be a stable government in the months to come, and that government would stick to the course that previous Modi governments have stuck to. And I think investors across the world, if you're not a portfolio investor and not looking to move your money very fast in and out, they will stand reassured by the fact that India's baseline GDP growth is expected to come in anywhere at 6.5% and more. We ended last year at over 7%. And I think they will feel confident about how this market shapes up, whether it's Apple or it's Samsung or it's GE. So I think things are coming back to normal after yesterday's shock results.
So what happens actually in terms of government formation? How long will it take? What kind of negotiations could we see?
Well, as I pointed out, the two key allies of the BJP have already reaffirmed their loyalty to that coalition, though, of course, they will be in negotiation to see what, what pound of flesh they can draw, given that, there is apparent weakness for Modi and the BJP. Now, the next date we'll be watching will be this weekend, when some media reports suggest that there might be the main swearing-in ceremony where Prime Minister Modi will be sworn in as Prime Minister. We'll know his cabinet formation then as key ministers are sworn in, and we'll also know what accommodation has been made for allies, and that will give us a sense of how confident the BJP is of holding this grouping together. It'll tell us who the key economic ministers are, and thereafter the next big cue will be the budget, because that will tell us what the revenue expectation and the expenditure pattern of this new government will be, how close it is to Modi 1.0 and 2.0, or whether Modi 3.0 tries to carve a very different path.
Thank you so much for joining us. I know you'll keep on top of this, and we'll get back to you throughout the day and throughout the week. Our senior India editor, Menaka Doshi. Now, President Joe Biden is planning 2 meetings with Ukraine's Volodymyr Zelensky in the coming weeks. The U.S. leader is seeking to show solidarity with Kyiv in its war against Russia, despite plans to skip an upcoming peace summit in Switzerland. Earlier this morning, the president arrived in France and will meet Zelensky this week on the sidelines of the 80th anniversary of D-Day in Normandy. A second meeting is planned the following week at the G7 summit in Italy. Well, coming up, it's a busy day for retail with Inditex earnings. Plus, we discuss how Birkenstock is actually convincing investors it's a luxury brand. This is Bloomberg.
As we see the supply chain improving, we keep ramping up. So the more they produce, the more we need, and we are very fortunate to have in front of us a very important backlog of orders to deliver. But that comes with higher rates if we want to be at the pace expected by customers, and therefore I think it will at least take 2 to 3 years to see a certain normalization.
Any company, especially large-scale companies who are willing to be transparent about everything, they'll suffer less. We presented this comprehensive plan to our regulator. Here's one thing I want to make sure everybody understands. This is our plan, it's not our regulator's plan. If we slow it down and stick to the disciplines that will synchronize this supply chain with the insatiable demand for airplanes and stay disciplined on that, we will put all this in a rearview mirror.
Well, that was the Airbus chief executive, Guillaume Faury, and the Boeing chief executive, Dave Calhoun, at the Berlin Aviation Summit with our Guy Jørgensen. Let's also turn to a top feature in Bloomberg Businessweek called The Ballad of Birkenstock. Now, it explores how the 250-year-old German orthopedic shoe company transformed itself into a luxury behemoth with family drama at the top of management like a hit TV show Succession. Our shares up nearly 30% over the past month on robust earnings. The company also raised its forecast for the year as consumers snapped up its clogs and sandals. Let's discuss all of this with Andrea Felstedt from Bloomberg Opinion. I mean, it's unbelievable, right? This is like an old company for, it was an orthopedic shoe, and then you can't even get them online.
It's about the fashion cycle. These things go in and out. I mean, I can remember at least 3 times over the last sort of 30 years where Birkenstocks have been in and then it's been out. But I feel it's kind of transcended that now, and it's sort of an accepted part of our wardrobe. It really has become a fashion staple, and young and old, everybody wears Birkenstocks, and that's quite a difficult thing to achieve, and it's not universal. I mean, we've seen Dr. Martens have an absolutely terrible time on paper, same as Birkenstock, but it's had 5 profit warnings over the last year because it was a great hit. We had the chunky boot, was a big look 2 or 3 years ago, and then it faded. So it's quite a feat to keep it going.
But Andrea, so again, Birkenstock and Dr. Martens both listed. Birkenstock, has done very well since the IPO. Can they keep it going?
I I think they probably can. I mean, it's been quite patchy since the IPO. It initially fell, and then it has recovered. I think if it can hold on to that fashion staple status, I think it can keep going. Whether it will be quite as strong, whether there will be times it's stronger, weaker, but I could see it carrying on.
I mean, in other fashion news, I mean, we have Shein that we're waiting for that IPO, and they've decided to list in London. And then there's also Inditex earnings.
That's right, and what we've seen with Inditex is it's almost become it's not a high luxury brand, but it's become like an aspirational luxury brand because the true luxury brands have increased their prices so much. The mid-market has shrunk. You've got people like Banana Republic struggling, shrinking. So that sort of middle, clothes for work, etc., is sort of shrinking. Inditex has filled that void. It says it's not a deliberate policy, but it has stretched its price range upwards to meet that demand.
Andrea, thank you so much. As always, Andrea Felsted there with everything retail. Coming up, the world's largest private equity event gets underway in Berlin. We speak to the co-chief executive of THL live from Super Return. Well, signs of a cooling U.S. labor market, buoy Fed rate cut bets, Treasury yields climbing after their largest two-day drop this year. The Indian Prime Minister Narendra Modi gears up for coalition talks after his party loses parliamentary majority, while stocks rebound after yesterday's sell-off. And here in the UK, Rishi Sunak and Keir Starmer face off in the first TV debate of the general election, with the Conservative and Labour leaders trading barbs over their rivals' tax plans. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Intel has agreed to sell a 49% stake in a venture that controls a chip-making plant in Ireland to Apollo Global Management. The $11 billion deal actually brings in more funding for Intel's massive expansion of its factory network. Well, Bloomberg's Danny Berger spoke to Apollo's Scott Kleinman at the Super Return Private Equity Conference in Berlin earlier.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo. but in general, just the need for this type of capital is insatiable.
Bloomberg brief anchor there, Danny Berger, speaking to Apollo's Scott Kleinman earlier. Now let's get back to Danny at the Super Return Private Equity Conference in Berlin with another great guest. Hi, Danny.
Hi, Francine. That's right. I'm pleased to say that we're going to continue a bit of the tech conversation. Joining me now is Scott Sperling, THL Co-CIO. Scott, thank you so much for joining this morning.
Very welcome. My pleasure.
We're just hearing to Apollo talk about their fancy new deal with Intel and chips. So I want to start perhaps an older part of tech, software.
Yes.
There's been some wobbles there. Salesforce had some earnings that quite disappointed the market. Saw something similar from Workday. We saw Vista write down $3.5 billion on one of their online earning platforms.
Right.
What's happening?
So I think it's a matter of more managing expectations than anything fundamental. Software still is a really attractive business model with its high recurring revenue, long-term sticky business model. The expectation of infinite growth for the overall markets, and then specifically for growth within the market for certain companies, that probably has gotten ahead of itself. And I think part of it is the enthusiasm for the new technologies that are coming online, particularly generative AI, where the promise is always ahead of the reality. And it takes a while for the market to adjust, but then those realities will sometimes, in fact, oftentimes, come to bear.
We were talking about this, Jensen Huang saying recently, you got to spend more to save more, and that's CEO math. So when you're looking at companies, especially when you're looking at ones to buy, how much of in your head are you thinking, is there an AI play here? How important is that, make or break?
Yeah, we look at it as either a great opportunity or an incredible challenge. And sometimes it's both. And some of it is the uncertainty about how it all unfolds. Right now, we're seeing generative AI be a valuable tool for a lot of our companies that provide either automation services to a broad range of customers, whether it's a healthcare system or it's a factory floor or it's a distribution center. We see the ability to use generative AI as a way to reduce the cost of code creation because of the very nature of how it operates. But there's also, again, more promise than there is reality to a lot of the things that we've been talking about. And it's going to be a long time before we see how that settles out. The cost of running generative AI is also quite high when you think about the compute power that's often required. That's something that we don't talk as much about, but it is part of the business model element of a broad range of companies who are in this area.
Do you think tech investing needs to change to keep up with this idea? Because presumably there's a lot of companies out there, maybe CRMs, that could easily be disrupted by AI that, this industry for a large part has liked those software deals.
And I think you're exactly right that there's a high risk of disruption of those business models. There's also the ability to look at what the implication for margin generation might be on more legacy or traditional businesses that now may use automated tools that may be generative AI based or not for a lot of their business processes. So take accounting firms. There is a belief that this technology will allow you to do a lot more, particularly on the tax side, for individuals and corporations. Early on, that may be a significant cost savings for these companies that lead to excess margin. The question is, how much will their customers let them keep? And so there's a dynamic here that's yet to play out that we know presents, again, opportunities, but also could have severe disruption risk to some of these underlying business models.
Now, the other disruption risk, I just want to get to this, Scott, is regulation. And I know one area you're very active in is healthcare. Now, the healthcare space, I know this is more technology, more systems for healthcare, but there has been increased scrutiny on healthcare from regulators. Again, more so on the people side and roll-ups and staffing, so not exactly where you are. But I wonder if that overall regulation puts an ice on healthcare deals. Does it make you pause at all?
I think it increases the risk pretty significantly on some of these deals and the very nature of healthcare. So I have this night job as chair of the board of the Mass General Brigham system. So I'm looking at it now from a not-for-profit, an enormous $20 billion not-for-profit who does research and very high-end clinical. And they do unbelievable things that us mortals couldn't do. And, it's really amazing. But the pressure, even on that not-for-profit, because nobody wants to reimburse to really truly cover the cost, is enormous. So if you're a for-profit going into this, you're trying to pick off the best payer mix. You want commercial payers as opposed to government payers. You want to do things that are going to drive the margin of your business up in ways that may not be as patient-friendly as what some not-for-profits do, all in an environment where the government wants to continue to squeeze the amount they spend on healthcare. And so that leads to a very difficult formula if you're in some of these for-profit players, and creates the political risks that we're now seeing manifest in the things that you're hearing from the Elizabeth Warrens and others of the world.
Scott, I do want to end here because it has been over a year since Thomas H. Lee passed away, your founder and someone you cut your teeth under. I mean, he started leverage buyouts before leverage buyout was even a word.
Right, a real pioneer.
A real pioneer. And again, the times were different then, and leverage has become another hot button issue because of where rates are. I wonder if you look at sort of the foundation of THL and where we are now and the concerns about leverage, is this a paradigm shift?
So the paradigm shift, Tom left us really in 1999, and then without economic interest starting around the mid-2000s. So the business, when Tom was with us, and he started real pioneer, the firm, focused on growth buyouts, mid-market growth buyouts, which at the time was unusual. That part, the culture that he created still exists in the firm. But the difference is we've grown dramatically because the very nature of what we need to do to generate the kind of strong returns we're aiming for has changed dramatically. So we have much more specialized expertise in the areas that we invest. We have significant investment in operating expertise. And this is true for a number of people in the industry. I think I'm characterizing more generally. But certainly I know from our firm, when you go from 30 people to 150 people, it's a very different world. And I think leverage is not as impactful as it was. The business models that we're seeing today, the impact comes really from the growth in EBITDA, the ability to manage to a acceleration in growth rates where you earn multiple expansion is a very important element of how we think about the business. And when you look at the capital structures that are now very equity intensive, it's a very different world than when I started 40 some odd years ago and you were putting up 10% of the deal in equity.
Right. Well, I mean, it's also a higher for longer world. Scott, unfortunately, we don't have time to get into that because that would take us another hour. But thank you so much for joining. Really appreciate
you are very
it.
welcome.
Francine, that is Scott Sperling, the THL co-chief executive, looking at everything from AI to higher for longer for a bit there.
There you go, AI to higher for longer. Danny, great work as always with Scott. Now we'll have plenty more from Super return throughout the day. Plenty more, of course, great guests joining us. Anuj Ranjan, the chief executive of private equity at Brookfield Asset Management, Ares management partner Matthew Chirtnell, and General Electric co-president Gabriel Caillou, just amongst some that will be joining us throughout the day. Coming up, Rishi Sunak and Keir Starmer face off in the first TV debate of the UK general election, trading barbs over their rivals' tax plans. More analysis next, and this is Bloomberg. Now to the UK election campaign, where Prime Minister Rishi Sunak and Labour's Keir Starmer clashed over taxes in the first TV debate of the campaign.
We will raise specific taxes, and we've been really clear what they are. We've already dealt with the tax break on private schools. We want to end the non-dom status completely. I think that the super rich should be paying their tax.
Independent Treasury civil servants have costed Labour's policies, and it's £2,000. But you asked for specifics, Julie. So let's have a specific difference.
Please let Mr. Sunak finish.
The Triple Lock Plus, so that we raise the personal allowance for pensioners and ensure that the state pension is never subject to tax. That's what you'll get under a future Conservative government. Keir Starmer hasn't matched that pledge, which means for the first time in our country's history, if Labour are elected, pensioners will pay tax. I do not think that is right.
Well, let's get more on all of this with Bloomberg's Carla Canuvet. Carla, thank you for joining us. It was an interesting debate. I thought it was a good debate. Who came out on top?
So that's always the question you have coming out of those. And in this case, I actually think there's something for everyone to take. The immediate snap poll right after the debate ended was giving a very small victory to Sunak with 51 over 49 against Starmer. So at the looks of it, at first blush, that would be a really tiny win for Sunak. But I do think that there's two other ways of looking into it. The one is Sunak is the Prime Minister, the sitting Prime Minister, who is coming into the debate with an over 20-point
disadvantage.
Yeah,
so it doesn't change the polls. This was basically a poll on how they did in the specific debate. It doesn't necessarily change the poll on how people vote.
No, I think in that respect, there wasn't really anything to move the needle. And again, it's good that the one going in defeated in the polls gets a lead. But also for Starmer, it's a matter of he already has the lead. He just has to keep it. Right. So that can also be seen as a win for it. But in terms of did anyone win the election on that night? No, I don't think anyone did.
Sunak's main attack was that Starmer would raise taxes. Did he land any blows?
Yeah, he did. I think his biggest blows were in terms of the NHS. And the big one was that in the track record, Sunak at some point was trying to defend that the waiting lists are going down, they're improving. And Starmer obviously latched onto that to say, well, in fact, while they are now coming down a little bit, they are still higher than when you first made the promise to make it better. So I think that was one of the best ones for him.
Carla, thank you so much for joining us. That was Carla Canuvet, of course, joining us with the very latest on that debate. Now, look at this. We have the King Charles banknotes, and they're entering circulation today. So where can you get them? At some post offices, but only a few because they'll be very gradually changed. The sovereign is being changed on the Bank of England's notes for the first time. We knew that there was actually a line in front of the Bank of England today. The portrait that you can see here of Charles is appearing on all four banknotes, the £5, £10, £20. and £50 with no other alterations to the existing designs. But it will be a very gradual change. Several post offices, for example, in London are issuing the new notes today. Now, coming up, we also discuss the UK housing market and the mortgage sector with the chief executive of Skipton. This is Bloomberg.
Most products are priced according to the value they bring, and I feel really good about the value of our medicines, what they bring to the individual patient, but also the value to the healthcare system. And we have today healthcare systems around the world who were typically designed for acute care, but finding that 80% of the cost in the healthcare system is linked to chronic care. And we have a portfolio of products that are really addressing some of the chronic diseases of our day and age.
Well, that was Lars Fruergaard Jørgensen, chief executive of Europe's most valuable company, Novo Nordisk, on the pricing of its blockbuster diabetes and obesity drugs, Ozempic and Wegovy. You can see that full interview on Leaders with Lacqua airing at 9:30 p.m. New York time tonight in the U.S. and at 6:30 p.m. London time on Thursday. Now back to the UK and rate cut expectations for the Fed, the ECB and the Bank of England have all pulled back in the face of stronger economic data and sticky inflation. Now, it could impact the recovery of house prices here in the UK 1 month out from the country's general election. Let's discuss all of this with Stuart Haire, Chief Executive of Skipton, one of the largest building societies in the UK, with consolidated total assets of around £37 billion. Stuart, thank you so much for coming on. There's so much appetite to understand what the mortgage markets look like, what it means for Skipton, and, of course, what happens in this general election. First of all, the housing markets appear to be stalling as the Bank of England hasn't cut yet. So how do you see that developing?
Well, alongside the Building Society, we also own the UK's biggest estate agency. So we see some real-time data. And what that tells us is that actually demand is up year on year. Now, it was a quiet year last year, but it's up about 20%. And that's because people are readjusting their expectations of what they can buy in the face of probably longer interest rates.
And so do you see a pattern depending on where in the country you're looking at?
Yeah, in London, for example, the rental market's going nuts. You're also,
that's a technical term.
A technical term. You're also seeing house buying, the number of house buyers in London starting to pick up as well. But it's actually a relatively broad swathe across the country. It's more affordable outside of London, which means there's more activity picking up there now as well.
So, Stuart, what's your outlook for house prices?
House prices, we think, will stay around the level they're at for the next 12 to 18 months and then gradually start to pick up to the long-term trend.
And so you launched the first 100% non-deposit mortgage also since 2008. How has the uptake been on that?
It's been fantastic, actually. Across our whole first-time buyer range, we lifted ourselves to helping over 20,000 people last year. That was up 70%. So we're feeling pretty good about first-time buyers. And indeed, the market overall, we're seeing more first-time buyer transactions than we've ever seen. 1 in 3 transactions in the UK are to first-time buyers.
So more lenders appear to be extending terms also to 30 years and beyond. Again, are there any risks to the mortgage market because of that?
Of course, yeah. I mean, basically, you're making debt last longer. That can mean that it's more expensive over the longer term. But it allows people to step onto the housing ladder, and then as their finances improve, they can actually adjust that term down as they progress through the mortgage.
But that's here to stay. It'll be 30 years or above.
So. I think look, house prices have inflated beyond income. Yeah. And that means that they become that bit more unaffordable. Yeah. So to get on the housing ladder, to be able to put that nail in the wall, which, you know, a lot of Brits aspire to, then they're having to make different financing arrangements.
Sure. Talk to me a little bit about what kind of policy you would like to see from the government after the election.
We're chronically, in the UK, we have a chronic shortage of houses. There's actually less houses per 1,000 people in the UK than there is in France, there is in Italy, across the whole of the OECD. So we need to build more houses, full stop. No. But we need more social housing. So we need to support planning rules that build social housing, private rental sector housing and residential housing for purchase. So overall, we just need more houses built. So anything that supports planning reform is really important to us.
Stuart, why has it been so difficult? Because everyone's fully aware of it. This is one of the policies that was telegraphed from the start.
Absolutely, but it's been telegraphed from the start, but we haven't had supportive policies around bringing capital into the housing market. We've had an awful lot of rules, planning rules created, and also local councils with planning departments that have been decimated. So we need some concerted policies. We probably want a politician, a housing minister, in role for a very long time as well, so that those policies can turn into reality.
Do you see the industry of real estate actually, real estaters changing? I know there's been a bit of consolidation. There's more also like independent websites that are coming up.
I'm exceptionally proud of the work that our guys do. 1 in 10 of the houses bought and sold in the UK is done through us. But we are ultimately concierge of quite a difficult process. And I think digitisation can play a part alongside the great humans that can help sell your houses. So I do see technology coming in there. I also see more vertical integration. So the whole home buying and home selling journey can be done through one operation.
I mean, what's the one thing that people ask you at dinner parties? Because you're like the mortgage expert, and everyone's obsessed with house prices.
Yeah, I mean, everyone that has a house is obsessed with their house price, not devaluing. Anyone that doesn't have it is when's it going to be
Want them to go down.
Yeah, so it's how stable is the housing market. And for me, as a 100-year bet, it's one of the best asset classes the UK's ever produced.
Are you surprised that we didn't see more defaults, given where interest rates have gone? Defaults or just anxiousness in the mortgage market?
Bluntly, yes. A little bit surprised on the upside. Now, that's a good thing. But don't forget, lenders have been stressing affordability for over 10 years now. So it's not just being able to afford the mortgage payments now, but potential increases. So there has been a cushion in household finances. But, for example, in the last couple of months, we've actually seen arrears coming down. So we're seeing people better able to adjust. But it does mean that some of their other consumption has had to reduce down as well to be able to afford those payments.
When you look at the last 18 months, again, there's been, the high-end property market has changed quite a lot. Will it change with some of the rules coming into place on non-doms, or do you think that's actually untouchable?
It's a very resilient market, London, for example. So we have 2 estate agents in London, John D. Wood and Hamptons, and what we've seen there is actually increased demand. London's considered a safe haven. It's a great place to come, it's a great place to visit in the summer, it's a great place to shop, and there is an awful lot of serious foreign money that is always interested in buying properties alongside aspirational Brits.
Do you think, is it really true that they say actually the mortgage market or house prices decides an election?
I don't think it decides an election. I think it plays a part, but it's to do with the impact it has both on the psychology of the UK and the economy. Because if there's an awful lot of houses being bought and sold, then there's an awful lot of people bringing tradesmen in, there's an awful lot of people doing work, and it actually lifts economic activity and it also lifts spirits.
But are you? Yeah, go ahead.
And I think generationally there is a real challenge for politicians just now, because I think there's a sort of trap whereby those with houses don't particularly want to see too many more houses built around them. No. But there's an awful lot of younger people who don't have the same opportunities that I had when I was younger to be able to buy a house.
Stuart, thank you so much. That was a wonderful update on the housing market. Stuart Haire, their Chief Executive of Skipton Building Society. Now, up next, Bloomberg Brief. Manus Karani is in New York. Danny Berger, of course, is in Berlin at Super Return. So they'll talk about markets, private markets, and there's a lot going on in India as well, with Indian assets finally, after the slam dunk that they had yesterday, getting up a little bit. This is Bloomberg.